What's going on, guys? Welcome back to another video. In this video, I've got another extremely important AMC update to bring all of you this afternoon. So what we're going to be covering in this video is the option chain analysis that I have done going into the end of this week. Now, the option chain really tells us a big story in terms of the potential for a gamma squeeze that we could have. And I also have some words of caution on anybody trying to trade options on AMC at the current time. Now, in addition to this, if you guys remember in a lot of my previous videos, there are only two key indicators that I am now looking at to tell me a couple of things: when we are getting close to the squeeze, when we are in the squeeze, and when we are near the top of the squeeze. Now, those two indicators are widespread market sell-off due to forceful liquidations of positions, and that is going to arise from hedge fund collapses and bankruptcies. We recently today have actually seen one of the first hedge fund collapses that revolve around the AMC and GameStop situation. Now, I believe that this is only the beginning, and it signifies to me that we are getting really close. Now, tomorrow, Wednesday, could potentially be an incredibly important day for us as AMC shareholders. We have the automatic margin call rules coming into effect, and we're going to go over the best case, mid case, and worst case scenario of what is going to happen once this proposed rule change is actually effective. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but the more people that we have staying up to date on accurate AMC information, the stronger our community becomes. And if you guys would like to earn 2 free stocks with Webull, valued up to $1,850, make sure you check out that link down below in my description. So this has been a very dramatic day for AMC. We've seen the stock go as low as down 7 or 8% throughout this trading day, but at the current time that I'm recording, we are about 2.3% in the green. This is a great day coming off of yesterday, and this provided for a great dip to buy, in my opinion. I was buying the dip today, and when we come over and look at the option chain going into the end of this week, we do see that $60 is another important level. There is a 24,749 open interest, which is essentially the amount of contracts that people are holding in their brokerage accounts at the current time. There are a couple of other strikes that have a high open interest, like this $80 strike, but something that I want to bring up is this $145 strike all the way down here. This has the highest open interest on the actual option chain. And right now, this specific contract is so far out of the money. Now, you have to think about who you are actually paying to actually get these contracts. It's typically the institutions that we are kind of up against in this situation, because these institutions need to raise some capital in order to meet their capital and liquidity requirements, because there is a very large liquidity and collateral crisis going on at the current time. So if you are trading options, this is something that I say every single time as a word of caution. If you are buying options, never trade with an amount that you are not willing to lose. But again, nothing I say in these videos is financial advice. These are for educational and entertainment purposes only. Now, looking at Ortex, we can see that the short interest today has gone up about 1.31% according to the estimated and reported data. Again, this data is not necessarily completely accurate, and it is not Ortex's fault, but we are seeing a rise in the short interest, a rise in the borrowed shares, and a lowering of the return shares, having a net borrow of shares of against AMC at the current time of about 1.22 million shares. Now, we also have a bunch of these T+35 FTD dates coming up, and typically when we see these T+35 dates, we do see a significant increase in the share price. Now, Monday, we were expecting to see one of these price increases because they were going to need to cover a lot of these failure to delivers, but we did not end up seeing that. Again, this is a causation versus correlation issue, but it is something to keep in mind that we have a lot of these FTDs coming into play over the next 2 weeks. Now, let's take a look at this hedge fund collapse. When we come over here, this is going to be the article. So, London hedge fund White Square Capital shuts after swallowing lofty GameStop losses. So, we can see that White Square bet against the U.S. retailer GameStop, the Financial Times reported today, which led to a percentage loss hitting double digits at the beginning of an already tough financial year. Now, in my opinion, if they hit a double-digit loss, anything above 10%, it's not really cause to close, wind down the fund, or they're actually collapsing. That's not necessarily the case. I don't think that we have the full picture here, but I have a brief explanation for this. And we're going to go over that a little bit later, but we should see how much money this fund was actually managing. So in Q4 of 2019, they had about $138 million. In Q1 of 2020, they had about $233.7 million. But we can see that over the past couple of quarters, they have massively taken a lot of losses and decreased their positions. Now, when we come over to this article that I've brought up a lot, this entails some of the giant banks in the UK and in the world are now barred from participating in these bond sales. Now, we know that a lot of these bond sales are used to post collateral in order to make levered trades. Now, JP Morgan acts as a prime broker, and so do a couple of these other firms as well. Now, if the prime brokers are over leveraged at their institution, eventually they are going to have to do something called a forced share recall. Now, a forced share recall is very different than a margin call, so I do not want you guys to get confused on this. In a margin call, you essentially have to get up to the maintenance margin requirement. You can do that in two ways. One, you can deposit more capital into your account by either selling off securities, or you could just deposit more cash. Or if you're super over leveraged, you'll get forcefully liquidated. A forced share recall is when an institution gets a notice from their prime broker that says, hey, we need these shares back right now. We are closing you out of your position. They are two different things, but both could be occurring at the current time. Now, I do think that the timing of all of this is a bit suspicious, that a lot of these banks are no longer allowed to get their hands on the collateral. When we come over here, we can see that the reverse repo market in the United States is absolutely skyrocketing, which does signify to me that there is a massive liquidity and collateral crisis right now, because what they're doing, what the banks are doing, are taking the essentially useless cash that has basically become a liability on their balance sheet because they have to pay interest on it, and converting it into these super low yielding treasury yields. This is 5 basis points. So they can post these as collateral. It's a really hot commodity in the financial market right now, and that is collateral. So now this is a bit more speculative. This institution, when we come back over here, White Square could have just been super over leveraged on their position, but a lot of the time, the brokers will make exceptions. They can make some backdoor deals in order to allow their clients to keep their positions. In this case, that is not what has occurred. And it leads me to believe that there is something different going on here. Does it have to do with the collateral crisis that is going on at the current time? I do believe it could be, but we most likely are not going to get the full picture of this. What we do need to understand, however, is that White Square Capital falling is, in my opinion, the first domino to fall. So I do believe that we are getting pretty close to the squeeze. We are seeing some of these market sell-offs. We have seen crypto sell off a lot, which I do believe could be a lot of these funds trying to get liquidity in order to attack AMC and GameStop at essentially a last-ditch effort before essentially tomorrow, which is going to be the automatic margin call rules that we are expecting. So when we come over here, this is going to be NSCC 002. It is therefore ordered pursuant to Section 19B2 of the Act that proposed rule change as modified by partial amendment number 1 SR NSCC 002 be and hereby is approved on an accelerated basis. This is going to go into effect tomorrow, and let's go over the best, mid, and worst case scenario of what could potentially happen when this rule gets approved. So here's what I am thinking. If they enforce this rule to the best of their ability, we are going to see these hedge funds really struggle. What this rule essentially entails is that they are going to be calculating supplemental liquidity deposits every single day instead of only around monthly options expiration periods. We always see the failure to delivers spike up around these types of times, the monthly options expirations. And a lot of these different funds are utilizing these intricate options tactics to make it look like they have covered their positions in meeting the closeout requirements that their brokers essentially require, but in reality, they actually aren't. So when this rule gets approved, in my opinion, the best case scenario is margin calls. They're not going to be able to short the stock as much, and it's just going to push us much closer to the squeeze. Now, the mid case scenario, is this could take some time to actually really get into effect and actually affecting all of these funds. It could take a month for this to really get going in order for us to see these margin calls. That is the middle case scenario. In the worst case scenario is this rule ends up being not enforced to the best of the regulator's ability, and it really doesn't make that much of a difference. But you have to keep in mind that the math in the due diligence has not changed. We still most likely own a vast majority or over the amount of issued and outstanding shares that are supposed to be out there for AMC, and we are still in the driver's seat in this position. But NSCC 002 and NSCC 801 are my favorite proposed rule changes, and the reason for that is I do believe that they have the possibility to benefit us as retail investors in the best way possible. It is going to kind of level the playing field in terms of how these institutions are able to get around these margin and liquidity requirements, and if we are all playing on the same playing field, the markets will become fairer. So that is going to conclude this update on AMC. If you guys enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people as possible. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. So I hope you guys are having a great day, and I'll see you guys in the next video.